So we believe that the U.S.-China trade war, along with some other conflicts around trade, has had a meaningful negative effect on business sentiment globally and global growth. What we expect to happen between now and year end is for the U.S. and China to find some way to call a truce. A truce which means there'll be a partial deal with some limited issues of agreement. There will be perhaps some modest rolling back of tariffs that have been put in place, but not a deal that creates a resolution in the conflict overall. So I think that will have a modest positive influence on global growth as we look towards 2020, as we've taken out the risk that the conflict intensifies. But because the conflict is not being resolved, it doesn't have the more meaningful potential benefit of having removed this issue from the way businesses are thinking about the future. I don't have a view about what our president is doing other than to say that there are legitimate issues for the U.S. and China to have to resolve in terms of how the two parties interact in global trade and global capital flows. And it would be hopeful that you can get an agreement where we can move forward without conflicts becoming a drag on the global economy. Well, I think what's interesting is that we have not seen significant negative effects of the trade conflict in financial markets, either in equity markets and credit markets. And we attribute that to, first of all, some optimism that a partial deal can be struck, but perhaps more importantly, to the effective supports that have been provided by policymakers, most notably the Fed and China on the fiscal and on the credit side, over the course of the last 6 to 9 months. We think that they have been important in terms of bolstering market expectations, keeping credit markets open, and it's an important reason why we think we can get through this environment without having a more serious damage done to the global economy. So 10 years is a long time. I think over the next year, we are looking to see the supports that China has delivered in terms of boosting infrastructure spending, in terms of opening up credit for local governments, and for supporting consumer spending to do enough to produce a bottoming in growth on a sequential basis as we turn into the first part of 2020. We do think the lift that you're going to get from there is going to be relatively modest. Partly because the conflict, as we said before, is not completely resolved, partly because we think once you have signs that the economy is starting to pick up, China is going to be removing some of that stimulus pretty quickly, and partly because we still think there is a secular set of drags on China growth, which include the demographic forces, which include the overhang of debt in the private sector, and as a result, we would look for China to basically grow close to 6% over the next year or two, but then over time see that growth rate move lower.